I challenge you to compete in this simulated investing tournament to win some serious money. I hope you'll join us. I'll be coaching you every step of the way.
I have some call outs with what the companies are saying about food inflation in those Q2 calls. And if you're listening to them, they're saying that the prices are going up further in Q3 and Q4 than they were in Q1 and Q2. So they're calling for further price increases, and it's much higher than what is reflected in the CPI. So that difference is, people just consuming less, maybe eating a little bit out of their inventory, et cetera. That's resulted in this type of a chart for food at home, sort of something, most people haven't even seen covering this universe, making new highs in the last month. On slide 25, you can see this is the differential between Howard's restaurants and my grocery stores. So people are seeing higher price increases at the grocery store than they are actually at the restaurants. Even though it's more expensive to eat at restaurants, the price increases are greater, and that stands out historically. The one call I have here is sort of a bunch of things are making these sort of newer highs, going up and to the right, except for meat, which was sort of a bad guy, right? Blamed as big meat during the pandemic. It didn't make new highs, so they were one of the first ones to go up, and they're no longer going up. So that's maybe a sign of what's to come. Costs for these companies are no longer making these new highs, and that's when we get to that margin inflection that we've been calling for. When their costs aren't going up as much and their price increases are continuing to accelerate, you get better margins. All the companies will say, elasticity has been much lower than they've historically been. They've been able to pass on price increases, and that's true. But what I would say is it was sort of an exceptionary. There are other reasons for that, and it wasn't just because the consumer had some more, help, right, from the government, or they're eating more at home. It was also because there was a shortage of competing products. The consumer was almost trained. They weren't sure if they were going to not be able to go to the grocery store, right? So the people were just accepting price increases, and there were a lot of stock outs. Like the out of stock level was sort of lower than where it had been. What's considered normal for a long time. That has just changed, right? That was one of the big changes, was that the out of stock level has now, in the last, I'd say, 6 weeks, been back to what is considered normal. So now, it takes a little while to retrain the consumer, but now they no longer have to worry about, I better grab that product because it might not be there the next time, or I might not have like the flavor I wanted or something. So, as they get used to that, there's going to be more price sensitivity.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.